Welcome back to The Explainer. Today, we're jumping straight into the really challenging art of portfolio rotation. We're going to look at a strategic pivot that might honestly change how you view your own investments. This is a real-world case study where an investor deliberately chose to trade safe, reliable yield for aggressive market growth.
Okay, let's dive into this. Why on earth would anyone intentionally sell off a stock that pays record-breaking dividends? I mean, it sounds completely backwards, right? If you've got a proven cash cow sitting in your portfolio, conventional wisdom says you hold on to it forever. But as you'll see today, sometimes sacrificing that short-term cash flow is literally the only way to capture massive long-term gains. Let's start by establishing the dividend baseline. We need to look at the portfolio's current state of safety.
Leading the dividend charge in early 2026, we've got resilient, high-yielding income counters like DBS, Fraser Centerpoint Trust, and Parkway Life REIT. So what's driving this? Well, DBS is seeing a massive 25% surge in wealth management income. They are absolutely solidifying their status as a private banking powerhouse. Over at FCT, their suburban retail spaces are boasting near full occupancy. And Parkway Life REIT, they just secured a highly lucrative new rent formula for their Singapore hospitals. And that operational strength translates directly into some really impressive first-quarter dividend bumps. You can see it right here. DBS is up a solid 10%. FCT eked out a 1.4% increase, even with high interest rates, and P-Life jumped a massive 15.1% year over year. I mean, these counters are delivering exactly what income investors dream of. The absolutely crucial point here is that this incredibly strong baseline resulted in a very pleasing 9.4% year-over-year dividend increase for the first half of 2026. When you're sitting on nearly double-digit dividend growth from super safe assets, honestly, the natural instinct is to just sit back, relax, and collect the checks, right? But this brings us to the counterintuitive sell. Sometimes, making calculated decisions means doing the exact opposite of what feels comfortable. To grow, you've got to prune. Let's look at the logical trade-offs made here with OCBC and VICOM. Take OCBC, for instance. Yes, it's a phenomenal bank, but the easy money from high interest rates, that's already been made. Without special dividends, its base yield drops under 4%, and the capital upside is essentially capped right now. And then there's VICOM. Historically, this has been a very reliable dividend pair, but if you look closely, VICOM is facing a really tough transition year ahead. We're talking margin pressure, rising costs, and lower expected earnings per share. Now, what's really interesting about this next visual is looking at the actual trade receipts. You can see the pure execution of this logic. The investor decisively trimmed OCBC to take profits and entirely divested VICOM. Actually, they locked in a clean 20% capital gain in the process of selling VICOM. They let go of those beloved, reliable dividends simply because the future growth ceiling for those specific stocks was just too low. So where does that freed up capital go? We're chasing semiconductor growth. Let's look at this pivot into the tech upcycle. This graphic brilliantly illustrates what's known as the dumbbell strategy. It works perfectly in tandem. You're trimming the safe banks and testing facilities on one end and funneling that capital directly into the aggressive cyclical tech upcycle, with players like UMS and Venture on the other. Let's break down that contrast directly. On one hand, you've got the steady, reliable, but firmly capped yields of bank stocks like OCBC. Sure, they're safe, but they aren't going to double your money anytime soon. On the other hand, you've got the aggressive growth potential of tech players in a semiconductor upcycle. Real demand is returning to the tech sector, and that offers a massive growth ceiling that banks just literally cannot match right now. And don't just take my word for it. Look at this quote straight from Venture's latest update. They said, "We expect these green shoots to grow in 2026. For a management team that's historically very reserved, this is uncharacteristically direct. It's a loud, clear signal that real demand in the semiconductor space is absolutely back, which makes the timing of this portfolio rotation super critical." Let's take a brief detour to look at opportunistic volatility plays. This is how a disciplined investor actively handles sudden market mood swings. Because, sometimes the market hands you a gift wrapped in a panic. The gravity of the broader market can catch up to perfectly healthy stocks, and that's exactly what happened with Food Empire. After going ex-dividend on May 4th, the stock surprisingly held its ground, but the very next day it slumped nearly 10% in a broader market pullback. It was this totally unexpected, overextended sell-off that honestly had nothing to do with the company's actual long-term fundamentals. Let's move to and see how this builds. Here is the actual purchase receipt. This is how you capitalize on a short-term market panic, by swooping in and buying that oversized drop. The investor accumulated more shares for a long-term growth story. It's taking a sudden market mood swing and turning it to your absolute advantage. Bringing all these threads together brings us to the total return philosophy. This is the overarching strategy that justifies sacrificing that short-term dividend income. The absolutely crucial point here is this number, 6%. The primary goal of this entire portfolio isn't just to blindly collect dividend checks. No, it's to achieve a 6% annual total return. This is the core of the total return philosophy. It means that collecting dividends is really only half the battle. Securing capital gains through these strategic rotations is just as essential to hitting that overall financial target. Look at this trend for the 2020 to 2026 first half dividends. Now, because of this deliberate rotation, selling VICOM and trimming OCBC, the second half dividend growth is expected to slow down a bit to the low single digits. But here is the kicker. Despite that intentional slowdown, the overall portfolio still aims to beat the record $30,100 in dividends achieved in 2025. To put that in perspective, they're managing to pivot toward massive growth without destroying their foundational income base. It's kind of like having your cake and eating it too. Which leaves us with a final, very important question to ask ourselves as we look at our own investments. Are you holding for comfort, or are you investing for total returns? It's just so easy to fall in love with a stock that pays you a steady dividend, right? But if its growth is capped and transition years are looming, well, that comfort could be costing you real wealth. Take a hard look at your strategy and see if it's time for your own strategic pivot. Thanks for joining me on The Explainer. I will catch you next time.